Of course, now that you know how to read financial statement, a logical next step would be take a look at the different conclusion you could draw from a company's financials. For the most part, this work is done by calculating and comparing several different ratios. Liquidity ratio are used to determine how easily a company will be able to meet its short-term financial obligations. Generally speaking, with liquidity ratio higher the better. The most frequent used liquidity ratio is known as the current ratio. A company's current ratio provides an assessment of the company's ability to pay off its current liability using its current assets. A company's quick ratio serves the same purpose as its current ratio. It seeks to assess a company's ability to pay off its current liabilities. The difference between quick ratio and current ratio is that the calculation of quick ratio excludes the inventory balance. This is done in order to provide a worst case scenario assessment. How well would the company be able to fulfill its current liability if sales are slow? That is, if inventory are not convertible to cash. Let's give you an example. ABC Toy, as you can see, the balance sheet here would calculate its liquidity ratio as follows. A current ratio of 1 tells us that ABC Toy's current asset matches current liability, meaning you shouldn't have any trouble handling its finance obligation over the next 12 months. However, a quick ratio of only 0.5 indicates that ABC Toy will need to maintain at least some level of sale in order to satisfy its liabilities. Profitability ratios. While a company net income is certainly a valuable piece of information, it doesn't tell us the whole story in terms of how profitable a company really is. For example, Google's net income is going to be absolutely dwarfs the net income of your local restaurant. But the two businesses are in such different size that the comparison is rather meaningless, right? That's why we use two following ratio. The company's return on assets shows us the company's profitability in comparison to the company's size as measured by total assets. In other words, return on assets seeks to answer the question, how efficient is a company using its assets to generate profits? Return on equity is similar, except the shareholder equity is used in place of total assets. Return on equity asks how efficient is a company using its investors' money to generate profit. By using return on asset or return on equity, you can actually make meaningful comparison between the profitability of those two companies, even if the companies are at a different size. To give you an example, using the previous balance sheet and the income statement that you see right now, we can calculate the following profitability ratio of ABC Toys. A company's gross profit margin shows that what percentage of sale remaining after covering costs of the sold inventory. This gross profit is used to cover overhead costs, with the remainder being the company's net income. Let's give you an example. Virginia runs a business selling cosmetic. Over the course of the year, her total sales were $80,000 and her cost of goods sold was $20,000. Virginia's gross profit margin for the year is 70%. Gross profit margin is often used to make comparison between companies within the industry. For example, comparing the gross profit margin between two different grocery stores can give you an idea of which one does a better job of keeping inventory costs down. Gross profit margin comparison across different industry can be rather meaningless. For example, a grocery store is going to have lower profit margin than a software company, regardless of which company it's run in a more cost-effective manner. Financial leverage ratios. Financial leverage ratio shows the extent to which a company has used debt as opposed to capital from investor to finance its operations. A company's debt ratio shows what portion of company's assets has been financed with debt. A company's debt to equity ratio shows the ratio of financing via debt to financing via capital from investors. Now let's talk about the pros and cons of financial leverage. There's obviously risk for a company to be very highly leveraged. There is, however, something to be gained from using leverage. The more highly leveraged a company is, the greater its return on equity will be for a given amount of net income. This may sound confusing. Let's take a look at example. So XYZ Software has 200 million in assets, 100 million of liability, and 100 million of owner's equity. XYZ's net income for this year is 15 million, giving them a return on equity of 15%. 15 million net income divided by 100 million owner's equity. If, however, XYZ Software's capital structure was more debt dependent, such that they had 150 million of liability and only 50 million equity, their return on equity would be much greater. In fact, with the same net income, XYZ would have a return on equity of 30%. 15 million net income divided by 50 million owner's equity, thereby offering the company's owner twice as great a return on their money. In short, the question of leverage is a question of balance. Being more highly leveraged allows for a greater return on the shareholders' investment. On the other hand, financing a company primarily with loans is obviously a risk way to run a business. Asset turnover ratios show how efficiently a company uses its assets. The two most commonly used turnover ratio are inventory turnover and accounts receivable turnover. The calculation of inventory turnover shows how many times a company's inventory is sold and replaced over the course of a period. The average inventory part of the equation is the average inventory balance over the period, calculated as follows. Inventory period shows how long on average inventory is on hand before it is sold. A higher inventory turnover and thus a lower inventory period shows that the company's inventory is selling quickly, and it's indicated that management is doing a good job of stocking products that are in demand. A company receivable turnover, calculated as credit sale over a period divided by average account receivable over a period, shows how quickly the company is collecting upon its accounts receivable. Average collection period is exactly what it sounds like. The average length of time that a receivable from a customer is outstanding prior to its collection. Obviously, higher receivable turnover and lower average collection periods is generally the goal. If a company's average collection period steadily increases from 1 year to the next, it could be an indication that the company needs to address its policy in terms of when and to whom it extends credit when making a sale. Now, here's a simple summary. Liquidity ratio shows how easily a company will be able to meet its short-term financial obligation. The two most frequently used liquidity ratio are the current ratio and quick ratio. Profitability ratios seek to analyze how profitable a company is in relation to its size. Return on assets and return on equity are the most important profitability ratios. Financial leverage ratio expressed to what extent a company is using debt instead of shareholder investment to finance its operations. The more leverage a company is, the higher return on equity you will be able to provide to its shareholder. However, increasing debt financing can drastically increase the business risk level. Asset turnover ratio seeks to show how efficiently a company uses assets. Inventory turnover and receivable turnover are the most important turnover ratios.